Good afternoon. We'll give people a couple more minutes to trickle in here. Try to get started just shortly after 5:30. A couple more minutes. All right. Well, I've got a couple minutes after 5:30. I'll go ahead and get us started, and I'm sure that folks may trickle in and join us soon after. So I'll like to introduce myself. My name is Jim Johnson, and this webinar today is put on by the Small Business Development Centers, which I'll talk about a little bit more. And just to make sure that you are in the right webinar, this webinar is on property management basics. So we'll go ahead and get started. Here we go. So once again, introduce myself, Jim Johnson. I am a business consultant, but I am also the region director for the Small Business Development Center located at South Carolina State University. We cover several counties in South Carolina, and I have each consultant in the network has different specialties, and one of my specialties is in real estate and property management. So I'll give you all a little bit about my background as far as property management goes. I've been a property manager for about 22 years. So it's been quite a while. And I have managed up to 27 doors. And currently I manage 9. I manage both residential and commercial properties. And I've managed multi units for residential, duplexes, fourplexes. So I pretty much have been doing it a while. So I have a good perspective of property management, and that's really what I wanted to get out to people in this webinar is, just the basics of property management, something that not everybody has. So I'll go ahead and move on. The SBDC, which is a Small Business Development Center. If you've never heard of us, we're an SBA program, Small Business Administration, and we are hosted by universities in South Carolina, which would include South Carolina State, Clemson, University of South Carolina, and Winthrop University. It's a consortium that hosts the program. So as you can see on the map, you can find SBDC locations all over the state. You can find one close to you. So we have around 50 or so consultants in the network, and SBDC consultants do business counseling, and we do workshops and webinars like we're doing today. And of course, we connect people with business resources. And that's one thing I'd probably like to stress today as we talk about property management and real estate is, if you are considering investing, or you already have the property and you want to work with an SBDC consultant on it, our service is free. It's confidential. One of the great things is, if we don't know exactly what the answer is, we can definitely find it for you. And folks like me in the network, I might have that specialty. So if there's a consultant in Greenville that doesn't have a lot of experience in property management, well, they can call me and then they can ask me the question. We can co-consult, or I can get you to the person that you need to get to solve whatever issue it is. And what that does really is save you a lot of time, and time's money. And it gets you to the right place, and hopefully gets you the right answers. So that's the big part of what we do as well. But just being able to talk with a consultant is huge. Just having that resource to go to. So SBDCs, you can go to the website there, find out more about us and how you can access the service. So today we're going to talk about 5 different areas of property management, starting with acquisitions, finding a quality tenant, which many of you could probably imagine that's pretty important, record keeping, maintenance, and other considerations. So disclaimer, got to put it out there to begin with, right? I'm not a lawyer. A lot of things that you do in relation to property management, you could use an attorney. Especially in the acquisition of the property, you need that. But it helps to have a good attorney on hand because you're dealing with contracts and legal issues a lot of the times. I rarely use a lawyer, just as a unless I'm acquiring or selling a property. I do from time to time though, and of course I have a great relationship with my personal lawyer, so I can talk to them about property management issues. So also, I'm not a licensed property manager. And I'll go ahead and stress that all the properties that I manage are my own properties. So if you own the property, you can manage it yourself. If you are managing someone else's property and they're paying you to do that, you need to be a licensed property manager. So that's illegal. You can't manage other people's property for money without a license. So you can also be a licensed real estate agent as well and do that. But look into that. If you want to manage property for money, you need to look into the property manager or real estate license and find out the different aspects. And I'm also not a licensed real estate broker or agent. And lastly, I would say, consult the South Carolina Landlord and Tenant Act. Just Google it, SC Landlord and Tenant Act. All your answers, your legal answers, are there in some form or fashion. That's the law that was written to govern, property management in South Carolina. So you can go. It's a great resource. I actually do go there from time to time, just to check on things. But after having done it for so long, I know they don't change these laws very regularly. I pretty much know what's going on. And last thing, consultant lawyer for legal issues, right? I'm not going to give you legal advice. I can give you some facts and things like that, but I'll try to stay away from any legal advice. So let's get started here. What's the benefits of owning real estate? And y'all probably all seen the different, commercials that come on, in the middle of the night or whenever, talks about being a real estate owner and making money on managing and investing in real estate. There's thousands of books out there probably. There's videos, there's YouTube, there's programs, there's everything you can imagine on investing in real estate and making a fortune, right? Become a millionaire. Well, I mean, there's a reason behind that because there are a lot of benefits to owning real estate, but like any business, there's a lot of risks. And I'll go through some of the risks here as well. So yeah, there's risks, there's rewards. You just have to be smart about it and you'll probably be okay, because in general, real estate is a great investment because they're not making any more land. And it's an asset that normally can be resold, and you can liquidate. And if you choose the real estate right and nothing really goes wrong with the market or area, your real estate should appreciate over time. And that appreciation is where you can capture, your return. One place you can capture return. Of course, if you invest in real estate or you happen to own real estate, cash flow is good. You can make cash flow off of rents. Between the difference between the rents and the expenditures on the property would be your cash flow, right? It's a tax deduction. There's a lot of, it's tax shelter. I'm not an accountant either. I didn't put that in the other slide. But there are a lot of tax benefits to owning real estate, especially if you have, if you're paying a lot in taxes. I'll just say that. I would advise, speaking with your accountant or tax preparer before you go to invest in real estate to see what the impact would be on your current financial situation. Likely it will be pretty good, especially if you have a good income otherwise. And then just plain ownership and having assets. So holding assets is what creates wealth. And wealth is, what can make you, what could sustain your business and your family and leaving a legacy for your family and all that good stuff. But, when you go to the bank to borrow money for business opportunities and ventures, and you have assets like real estate, you can utilize those assets to access more money. And so it's a huge benefit. That's one of the hugest benefits of having real estate, just holding that asset. It's money in the bank, basically, is what it is. Instead of putting it there, you're putting it in real estate, and real estate is pretty good investment. But like anything else, there's always an exception. So if you can buy bad real estate, for sure. And I'll try to talk a little bit about that as well. So what are some types of real estate? What are some business types of real estate? A lot of times you think of real estate investment, you're just kind of thinking, residential or maybe even commercial, right? You can buy a rental house or buy a single family residence and rent it out and make money on, on the spread, on the difference between your expenses and your rent. Or you can invest in a duplex, multifamily, and make money that way. I think a lot of people, when you think about it, that kind of comes to mind first is just that residential type of rental property. Condominiums included in that as well. Then, but there's also commercial real estate, which I mentioned. And honestly, today, this conversation is going to be about residential investment, because you can go down a whole nother rabbit hole talking about commercial. It's a total different industry. It's kind of a different, approach and strategy to investment. I have been managing commercial real estate for probably 15 years, I guess, not quite as long as residential. I started in residential and eventually went to commercial. And now I mentioned that I'm down to 9 doors, and those are mostly commercial. So I'm getting out of the residential side. But commercial could include retail spaces, office spaces, lodging, bed and breakfast, a lot of things, right? So there's commercial real estate investment. There's industrial. If you happen to own a warehouse, could be leased to businesses that do warehousing, logistics. So there's industrial property. There's land. So your real estate investment can just be on vacant land. And then there's a lot of things you can do to utilize your asset and get a return with just land. Agriculture, timber, hunting rights, camping. There's something called Hip Camp. I don't know if you ever heard of that. It's an app that you can download, and if you have land, generally it's probably decent property that maybe has access to a pond or access to other amenities and stuff like that, you can, make campsites on your land, and then you can rent it out to, people through hip camp. So another way to kind of make money on your land. And then there's other specialty types of real estate. I call them event venues, shared workspace. Y'all may have heard of like WeWork. That's a commercial type of office leasing, but I'd say shared space comes with more like features, like technical assistance or access to, other business services. Just think WeWork. Y'all can look that up. There's virtual space. And when I say virtual space, some people need an address, but that's all they need. So you can have kind of like a shared space where people can have a mailbox and it's a virtual office. And then there's the ground and air leases and stuff like that you can get into. And this is probably not a totally extensive list, but it encompasses a lot of different types of real estate businesses that you can get into. But for today's purposes, we're going to focus on residential because I think that's what most beginners or people starting out, this is property management basics. So most people who start out, they probably start out in residential, unless you end up with, acquiring a property that was inherited, right? So hiring a property manager, one of the things that you should consider straight off the bat is whether to hire a property manager or not. So if you're currently own investment property and you're managing it yourself and you're just trying to get a little bit more information from this webinar, or if you're thinking about investing in real estate, or if you are going to inherit some real estate and maybe you're just, trying to get a better idea of it. Property managers are a big consideration because if you're a novice, you get yourself in trouble, and they're highly worth the money that you pay for them, property managers. And personally, I can say from experience, the last 20 years, I've used property managers on and off. So sometimes I get real busy. I might give them, half of my portfolio properties and have them help me manage it. Other times I've had them manage all of it. So I could just like check out of it for a little while. And then I take it back after a while. At times they might just manage one, and then property managers have different services too that you can utilize. You can utilize their, turnkey, which is you don't want to do anything with it. Just send me a check at the end of the month. I don't want to hear about it, see it, nothing. That's going to be on, you see, I put a 10 to 15%. They take 10 to 15% of the gross revenues, the properties, but it could be higher than that. Depends on the market and depends on the services they're offering. Like if they're total turnkey, they might go more than 15. If you're doing more, like you're doing the maintenance, you're handling some things that might be as low as 10%. It just depends. And any rate is negotiable. Some property managers may be more negotiable than others. Just depends on the agency, right? And property managers are not all created equally either. There's good ones and there's not so good ones, just like any industry, right? So you just kind of feel that out for yourself if you're going to work with them. So what are some services that they offer? Recruiting. That would be recruiting tenants. And when they recruit them or advertise for them, they screen them for you, which you'll see is very important. And then they would onboard that tenant for you. Part of the screening and onboarding is, filling out applications, doing background checks, just making sure you have a quality tenant, right? And then, of course, they're managing that tenant over the period of time that tenant is in your property and as long as they're under their management. When they handle separation, when the tenant leaves, and post separation, with the deposit and seeing if things, are all in order. They handle accounting, and they will even handle paying bills and taxes and whatever else you have. So essentially, a turnkey would be all those services. But you could cut back on some of those services, like paying the bills, and things like that. And, your rate might be lower. So also, I'll say that, they can be well worth it when to hire. If you've had a tenant in there and they become a problem, you could hire a property manager to help you get rid of that person, right? If you don't want to deal with it, and it's a lot to deal with. And if that's not something you do on a regular basis, then hiring somebody to do that would help. So they can take over, get the tenant out, get a new tenant in there, and continue to manage it for you. If the property's too far away, that's probably a good time to hire a property manager. If you buy like an investment property in the mountains, you probably want to hand it over to somebody up there because they know all the maintenance people in that area. They know the market. They know they can check the property. You're just not gonna be able to do that. Also, you may be able to work to write off some PM fees. Generally, that's a deductible item in your business, but always check with your tax professional. So if they're taking 10% of your gross, all those are deductible. So there's kind of a tax advantage of hiring them as well. But they could save a lot of headache. And if you really don't know what you're doing, people can take advantage of you, and they will, and they do. And property managers just aren't going to let that happen if it's under their, purview. And it puts some separation between you and tenants. Maybe if you don't want that, people knowing who you are, where you live, and things like that, ton of good reasons to hire a property manager. Highly recommend it. But you can also manage the property yourself, which is what I've been doing for a long time. So start out with property acquisitions. And so how can you come across property? And this is not an investment seminar. I'm not going to teach you how to invest in real estate, although you might get some takeaways here. But a lot of people inherit property. So I've been, fortunate myself to inherit property from my grandfather. And, a lot of people end up with property. And some people end up with good properties, and some people end up with not so good properties when they inherit it. Actually, my grandfather left us a property that was in the family for generations. And in 1960s, the interstate was built straight through my great-grandfather's farm, and it cut off a piece on the other side of the interstate, which was like a half an acre, and then the other side was pretty good. But anyway, that little piece on the other side is just worthless. You can't build anything on it. You can't put a sign out there. You can't access it. There's no access to it. It's a landlocked piece of, real estate, which had no real value. Although the taxes aren't very high on it either. But you might get inherited. You might get a liability. You might get a building that is dilapidated, and the city is trying to, get you to fix it up and do all things. It might just be a huge liability to you. So inherited can go both ways. But that's one way to acquire property. Of course, there's investment, residential and commercial investments. And of course, managing for others. Got to be licensed in South Carolina to do that. So several different ways to acquire property. If you're considering acquiring property, whether it's you just kind of came across it or you've had it for a while and you want to know more about how to have a good, solid business, how to do things, appropriately and formally, or if you're thinking about getting an investment, you need to consider business entities. Um, you know, like you can own a piece of property. It can be in your name, your spouse's name, and y'all can operate the business. You file your tax returns on your Schedule E, and if it's a sole proprietor, if you and your wife are partners in there, then it'd be a different one. But it'd be a partnership. Uh, but you really need to consider, what type of entity the property is in and what type of entity you operate as a landlord or property manager. Um, and normally, I would recommend an LLC, limited liability company. You can actually deed your property into the LLC. And what some property owners do who have multiple properties, they will deed each individual property in a separate LLC. And what that does is it creates a wall of liability protection between you and the tenant, or anybody for that matter, who could sue you in relation to that property. So if that property is in an LLC and something happens, then and they sue you, then they can only sue the LLC for the value of the LLC, which would be the value of that property. Now, that's also to say, and I'll go ahead, I'll put this later on as insurance. Obviously you're going to have property insurance. You don't have to have property insurance if you outright own the property. If you have a mortgage, it's likely that you'll have to have property insurance. But I would recommend, if you're going to have tenants, you're having liability insurance and property insurance, because LLC can be a line of protection, but your insurance is your big line of protection, because they're going to settle it for you, and they're going to handle the aggravation of a lawsuit. Your LLCs can be breached. Don't think that they're impenetrable and a total, oh, I'll put an LLC, I'm fine, right? No, because if something happens to a tenant and they get hurt on your property or whatever it is, negligence and maintenance, and the ceiling falls down on them, or whatever the issue is, they hire a lawyer. The lawyer will start to do research on your business, and first they'll try to find out if your business, how your business is owned, if it's in an entity. If it's in an LLC, they'll be like, okay. They'll also try to find out if you have insurance. And then that's the first thing to do. You call an insurance guy. All right, let's make a deal. And then what'll happen, they probably settle with insurance. But if for some reason you did have insurance, they're going to then say, well, does this landlord have anything really worth us going after? And if they feel like you do have something, after a little bit of research and trying to figure out your assets, then they might go after you, and then they'll try to penetrate the LLC. And they'll do that in a lot of different ways. One way is, did you set your lease up in the name of the LLC? Or was the agreement between the tenant and you personally? So if it was between the tenant and you personally, then they'd be like, oh, well, this agreement is between him and the tenant and not the business. So boom, we get around the LLC. If you sign the lease in your name, and that's it, let's say you put it in the LLC, you sign the lease in your name, then the attorney might be like, well, he's just signing his name to the lease. So, maybe that's personally, him, it's a personal thing. So you always sign, like for your LLC, you should sign, like in my case, Jim Johnson, signing for the LLC. So I'm not saying, it's just little things that you have to consider, whenever you deal with a lot of liability. If you have high liability, these are things you need to think about. If it's low liability business, then, not as big of a deal. But I would say that rental properties are kind of moderate liability, depending on the type of tenants you deal with and the property they're in. But if you have insurance, there's a lot more peace of mind. So so I would recommend having some business entity above and beyond sole proprietorship, which is just you, that really exposes you. And there is a corporate, there's a corporate, you can be a corporation too. You probably don't want to be sub S or sub C corporation until you get to a certain size. Then that might make sense. And that's the question for your accountant. But starting out as an LLC is the way to go. So I mentioned this earlier, some types of properties: single family resident, which is basically, just a home that families live in. Um, they're very popular for people. A lot of people look for single families to rent, especially in my market. I'm in Orangeburg, by the way, and I'll talk about that a little bit more later. But single family residents are very popular and they go pretty fast, especially a 3-bedroom or bigger. 2 bedrooms, I mean, people want at least 3 bedroom and 2 baths, obviously, if they can get it. But the thing about single family residents is they don't always work out as on paper as well as multifamily. You just can't make as much on them. They're easier to sell. Like, if you buy a single family, you rent it out for a couple of years, you get some equity in it, and you turn around and go and you do some maybe work, turn around and go sell it again. Won't have too much problem probably, because there's a big market for single family residents now. And as y'all all probably know, the real estate market's doing pretty good right now. It's a seller's market. Um, so if you want to sell your properties, you do pretty good right now. If you're buying, you got to be you got to look for the deals and really try to find them to make it all make sense. So multifamily residents, is another type. And generally speaking, you can make more money on a multifamily because the per unit cost goes down of the transaction, and it's just more efficient. There's more efficiencies in it. If you have vacancies in multifamilies, then, if you have a single family, somebody leaves, you have 0 rent. If you have a multifamily, if you have a fourplex, for instance, and one person leaves, then you're just down 25% in revenue. You're still getting 75% to cover your expenses, whether you have a mortgage or not, a loan payment. So there's condos. Condos are neat. It's just you have to worry about extra fees like homeowners association fees for condos. And with some multifamily and single family, you might have to worry about those fees and things like that, especially if they make you replace roofs and stuff like that. Those expenses you need to, think about. Of course, commercial and land, I talked a little bit about those. So how about funding some of these acquisitions? I'm sure if y'all are looking at investing, y'all might be interested in this. So there's a lot of different ways you can buy a rental property. Cash purchase, that would be the best. If you have all cash and can buy a property, I mean, the transaction can be so easy. You don't have to deal with banks. You don't have to deal with a lot of stuff. And it can be done quickly. And that's the best way. But not everybody has just cash to lay out, to buy a property, especially if you're considering hundreds of thousands or millions of dollars in a cash purchase. So then there's bank financing, which the vast majority of people, finance properties. And for a long time, pre-2008, getting a bank loan on an investment property was pretty easy. It was almost a matter of going down and signing a piece of paper, and that was it. Or just calling them and saying, hey, this is the property. And the approvals are just done in a matter of days. Of course, that all changed after 2008. If you're interested in knowing what happened in 2008, like my daughter asked me and my son, watch The Big Short, a movie called The Big Short. And it talks about that 2008 real estate crisis and the Great Recession. Things have changed with banking since then because we had the bank bailouts and all that stuff. And it has not been easy to get financing for especially investment property from banks, conventional banks. it's not impossible. And now that we're 10 years past that, it's become easier, but still not like pre 2008. So bank financing, I mean, if you have equity put down, and they may ask for even more equity. So they may only give you 70% loan on the value of the house or property, and you have to come up with 30% equity. It may even be 50%. It just depends on the bank and their risk tolerance. Some will go up to 90. They may even go higher than that. A guarantee, there's something called an SBA guarantee or USDA guarantee, FHA guarantees. There's a lot of guarantees out there. You just have to see if the guarantee is right for the type of property or the type of transaction. Some of those guarantees might not work with investment. But another strategy is you can buy the house for yourself personally. And if that's the case, sometimes you can get up to 95%, in loans, and have to put 5% equity. You live in the house for X amount of years, fix it up, then turn around, buy another house and turn that into an investment property. It's a strategy, and people call it the ladder strategy. And in the ladder, you can actually, you would buy the first house, and then you would flip it and make money, and then buy a bigger house, and flip it and make even more, and then buy a bigger house. And then you could eventually buy another house and turn that one into a rental. So a lot of different things and stuff that goes on, strategy and ideas around, how to acquire and make money off of real estate. Can't go over it all here. I'm just trying to give you your basics, remember? So owner financing is very attractive if you're going to invest in property. And a lot of these programs that tell you how to get into real estate investment with no money, that's going to be the cornerstone. That's going to be one of the cornerstones of their program or their concept is owner financing. You approach the owner and say, hey, I'll buy this property from you, if you'll finance it from me, and I'll put X amount of equity in, whatever you can negotiate with the owner. Gotta find the right owner though. And it's gotta be the right property too, because we'll get to that, but it really has to be the right owner, because not every owner is in the position to do that. They might have a mortgage. They may just want their money. In some cases, you may come across a wealthy owner, or just an owner that doesn't need the money, or the sale of the property would cause a large capital gains tax impact on that owner. So it would make sense for him to finance it and kind of get, payments over the years so he can string out his tax liability. But you got to find, the right person who is willing and able, and it makes sense for them to do that. You'd have a hard time convincing somebody otherwise. So anyway, owner financing is great. And you can do some partial stuff, that gets into that stacking down at the end. Bank might give you a loan, owner might finance a part, you might put in some equity, to try to make the deal. So anyway, there's third-party equity financing, which is investors. So if you can go out and find people who invest, you might put together a couple investors and y'all can buy properties cash, right? Where you all put in equity, and just make cash deals, which are a lot easier. You could save a lot of money that way, and you might get people down on their price if you either exclude an agent who gets a fee, or you can just say, hey, we'll close on this thing in less than 30 days, cash done, easy deal. But that requires you to find investors and create investment funds and things like that. And there's all kinds of your regulations and rules around that. So look into that. I'm not going to go too deeply into that. Could be family investors, could be outside investors. You just have to understand, and you're going to be in business together You need agreements in place, operating agreements and things like that to protect yourself. And partnerships can be tricky. I also say there's I put grants down here. I'm trying to remember why the heck I put a grant down there. There's not going to be too many grants for real estate for the most part. There might be some grants to improve real estate, the energy efficiency on your real estate. There were grants over the pandemic. There's COVID grants. So if you were affected, if you have real estate and rental properties, there are grants out there through the SBA and the federal government that can help if you didn't already access that. There are also grants for your tenants to pay you rent, which is important depending on the market you're in. And then lastly, I'll mention stacking. Stacking is when you take multiple financial products to try to make a deal. Like I mentioned, you get part of the loan from a bank, maybe two banks. Maybe you get two banks involved, right? And one bank does 40%, another bank does 30%. You do a little 20% owner financing, and you put in some equity yourself. That would be stacking different financial products to make the deal work. I know why I put grants down there. Because there are, I should really call them, they're not grants. They're tax credits. So there are tax credits out there for historical buildings in certain areas. There's a new market tax credit. There is a opportunity zone tax credits, all very complex, by the way. Not any deal that you would want to do. The new market and the opportunity zone, or I'd say new market, would be an over $5 million project. The opportunity zone might can go lower than that, but they're going to be big deals because it's just too expensive unless it's a big deal. You wouldn't use it on a single family. The historical tax credits you could use in commercial, but there are tax credits out there and there are some grants out there, but not many. I mentioned insurance before. I mentioned the LLC, how it could help protect. It offers liability protection. You want in a landlord policy, which liability and fire could be more comprehensive than that as well. And honestly, if you have multiple properties, you want an umbrella insurance policy that's going to maybe cover any gaps and things like that. It also increase your liability limits. But I would definitely talk to your insurance agent and, get advised by your insurance agent on what policies are out there and what is it? Tell me what it means here for me. What's included, what's not included, more so. So if I get in trouble, then, I know what's going on. And lastly, every tenant that I have, I offer renter's insurance. Any landlord policy does not cover the contents of the property. So that would be the tenant's personal belongings and their personal property. None of that's covered by any of your insurance. So if the place burns down or natural disaster occurs and they lose everything, they should have had renter's insurance. It's pretty cheap, so I always, and it has other things in it that might be beneficial to them. So yeah, I always promote that and, suggest they get it. So I talked about some of these investments and, one of the first things that you should do, obviously I'm going to get into talking about markets and where the investment is in the next section. But one of the first things you do is put the numbers on paper. Does it make sense? And what kind of return on investment will I get? And there's two ways to look at it, a cash versus a leveraged investment. So we're going to look at cash first, okay? And I'm not going to get too deep in this because, you start talking numbers and people, drone out a little bit. But, if you're going to invest in property or if you have a property or, you're getting one, it's good to know these. So anyway, let's just say we found a property for $100,000 and we're going to pay cash for it. So the way you calculate ROI on a property is you would close on this property, and let's just say there's $1,000 closing costs. You might have to put some remodeling in. $9,000 brings your total investment to $110,000 for the property. So you're going to rent this place out for $1,000 a month. That's going to be your revenue. So a year later, you rented this place. Every month, miraculously, you've got $1,000, and so you earn $12,000 in rental income for those 12 months. And then you had other expenses, which might include water bills, property taxes, insurance, different for every property. You'd have to look at the property individually. Total all those up. In this case, it comes up to be $2,400 $2,400 a year, or $200 a month. So your annual return was $9,600. So you take your expenses, $2,400, and subtract that from the gross revenue, which is $12,000. You get $9,600 left over. So let's calculate the ROI. So you divide your annual return, which is $9,600, by the amount of the total investment, which is $110,000. So if you look at the bottom, you do the math, you come up with 0.087, which is 8.7%. So your ROI on this deal is 8.7%. So that number is significant in that you need to understand the investment in relation to other investments. You have opportunity costs of where your money goes, right? You can invest in stocks, bonds, small business, gold, all kinds of other stuff. What's the return on those, right? Compare. Also, this particular number doesn't give you the whole picture of real estate, because we mentioned before there's appreciation. There's just the fact that you own an asset and it offers you leverage to maybe get more money or do other projects and all these others. There's other considerations just in the plain 8.7%. So if you have other things, you have to take everything into consideration. But what's going to be interesting, I'm about to show you ROI on a finance project. So in this finance project, same $100,000 project, but you're getting a mortgage on it and you're getting a loan. And so the bank says, well, you need to put 20% equity in and we'll give you $80,000 or 80% of the project. So you put down $20,000. Closing costs were a little bit higher because you had to pay, the mortgage fees and all kinds of other stuff. So maybe it was about $1,500 more. You had $2,500 in closing costs. Then, of course, you paid that $9,000 to remodel. So now out of pocket is $31,500 instead of the $110,000, right? So you only put $31,500 of your cash into it, which is $20,000 plus the $2,500. So now there's also ongoing costs related to the mortgage. This adds a new cost over and above your normal expenses that you have the property. So now let's say you got a 30-year fix, 4% interest rate, you borrowed $80,000. Your payments would be $381.93 on that. So you got the mortgage payment every year. But you also have those other same payments we talked about, the water taxes, insurance, stuff like that. So that's another $200 a month, right? So add those together, you've got $581.93 a month in expenses. The rental income still $1,000 a month is what you're getting. So that's $12,000 a year. So your monthly cash flow is $418, and you get that number by subtracting the $1,000 a month from the $581.93 in mortgage payments, right? And other, the $381 in mortgage, $200 in other expenses. So it leaves you with $418.07 left over. So now 1 year you go back and look, you had $12,000 in rent. Your annual return was $5,016. So that's because you had the expenses of $418.07 over the 12 months. And then you were left with $5,016. So now you would take that 5,016 and you would divide the annual return by your original out-of-pocket expenses, which in this case, remember, was only 31,500, not 110,000. So you take that 5,016 divided by 31,500, you get 0.159, which is a 15.9% ROI. So as you can see in this deal, you actually get a better ROI when you finance the project instead of paying all cash for it. So that's the beauty. That's what they say the beauty of leverage is. Using other people's money, OPM, other people's money. Leverage actually gives you a better ROI in your investment. There's a lot of avenues of thought on paying, on debt, on having debt. You have a conservative side which says you don't need any debt, and then you have more progressive that says there's good debt, and there's good debt that can help you grow, and there's debt that can, you know, help you make more money and all that good stuff and give you better returns, higher ROIs. But, you know, so there's a lot of arguments on both sides of it. You know, probably being moderate is the best way, somewhere in between, right? And just not being crazy risk and too risky, and not being too risk averse either, to where you really don't make a good return on your money. So what I would say to debt is also consider, you know, all your options to your opportunity cost and the other investments you can be, you know, putting things in. And also always diversify. Don't put all your money in real estate. If you have, you know, a lot of money to go around, you should have, you know, retirement investments and stocks, bonds, and things like that. You should put some stuff in real estate, and maybe some in small business and other areas. Diversify, because if the real estate market crashes, you'll be hurting for a little while, because likely it'll come back because it'll go in cycles. But, you know, just make that consideration. So that part was kind of on acquisitions and what you would need to consider buying property or acquiring property in some method. Pretty important. Finding quality tenants. This is, if you're gonna do the property management, this is important. But it really starts with the property that you acquire, and I'll get into that. So, marketing location. I put the little picture down there because I saw it on Facebook, in this group that I'm in, this landlord and tenant group, and I thought it was kind of funny because under it, or the meme said location, 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 because the little house is renting for $840 a month, but it's like, you know, near the beach. You know, it's like a block or two from the beach. So, yeah, I'd say the $840 a month is probably worth it in that. So it doesn't look it, you know, right offhand. But, you know, it's location, 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 you know. And that's really holds true for real estate. And if you're considering a market, I mean, unless you inherited it, you can't do anything about that. But if you're looking at investing somewhere, you really need to consider the location. And one example is like in Orangeburg. Let's just take Orangeburg, for instance. And the market and the demographics of Orangeburg is it's a blue collar town, and you have a high percentage of renters who all have, really, they live paycheck to paycheck. And there's probably a good amount of turnover in rentals in the Orangeburg market. So you have to understand the market that you're getting into is your prices of your rents are going to be capped, because there's not a whole lot of wealth in the area, not a lot of big, good quality jobs in the area. There's some manufacturing and some other jobs, but, you know, a lot of quick service, a lot of government jobs, which government jobs are good. But, you know, there's a lot of low income and things like that as well. So if you're coming to this market, you have to consider that, because you're going to be capped out on your rents a lot of the times for cash paying renters. But you can also get into Section 8 and low income. And that's just a whole nother thing. I'm not going to go too far into Section 8. I mean, government pays the rent for you, but there's drawbacks to everything. There's nothing in life where there's not benefits and drawbacks. You know, some types of renters can be harder on the property, which increases maintenance fees. You have to abide by rules and regulations of the government if you're Section 8. A lot of things like that, right? And you could have subsidized housing too, you know, for other purposes as well. But you know, I really say, hey, if you're going to buy something, really consider the location. Look at what amenities are in the area. Look at what jobs, manufacture. I mean, what type of jobs are there? What's the median household income? Where is this neighborhood a growth area or is it a decline area? What do the other houses look like in the neighborhood? You know, a lot to consider when you're thinking about location of the property. What are the community amenities? What's the population growth? Median household income. I just said all those. Access to jobs, tourist locations. Is there stuff to do for the people that live there? I mean, are they going to be happy there? I don't know if y'all have kids that play. There's a game called Sim City. And honestly, I played that game myself, and I'm not a kid. I'm 47. But anyway, SimCity is actually a pretty cool experiment, a game in, you know, like a community development and things like that. But it's also a good lesson in real estate, because if you play the game, you can see how all that stuff works. You know, do you have garbage, you know, disposal? Do you have, what are the amenities of the community? I mean, so what's the police protection like? What's the fire protection like? I mean, a lot of stuff to take into consideration. And to talk about fire protection, if your property is out in the country, rural, it's going to be harder to rent. And also your insurance rates are going to be higher, because if they don't have access to fire protection or close by fire protection, then your rates will go up. You might have a volunteer fire department close by, but how close are they? Where's the closest fire hydrant? You know, all that, you know, your location's your expenses might rise just because you got something in the country. But other expenses might lower too. So you just have to look at the whole picture. So marketing, the location, to me, is one of the key ingredients in a successful property. So going back to what makes getting good tenants, the location. Like if I have a condominium in Hilton Head, I mean, I probably wouldn't have too much problem renting it and getting what I wanted. Or if I have property in Charleston, downtown Charleston, or, you know, you name the market, y'all know them around the state, most likely. The ones that are really good, growing. Of course, the expense of the house is going to be higher too, but you just got to do the numbers to see if you can figure it out. The idea is to find, you know, the diamond in the rough, the one that, you know, needs a little work, or you can get kind of a discount for one reason or another, but it's in a growing area. You know, prospecting and trying to figure out where that is a whole job in and of itself, and a lot of people do it. But anyway, it starts with location, because you can attract good tenants to a good quality location, and also the quality of the property. If you have a rundown property that needs a lot of work, got leaks on the ceiling, everything's just needs help, cracks in the cabinet, you just aren't gonna attract as good of a tenant with a marginal, you know, maintained property. You can attract a tenant with just about any property, because there's somebody out there that's willing to pay for a place to live. It could be real bad. We've all seen them. People live there, and there's landlords who collect rent from them. But to be, I mean, you don't want to be that kind of landlord, slumlord, they call them. You want to take care of your properties for your liability reasons, to be a good business, to have, it's your brand, right? It's your property. You want to have a quality property. You want people to respect your property. If you don't take care of it, they don't either. If you do, you attract good tenants, they take care of it. So the quality and the maintenance of the property is important. Pricing, do market research in your area. There's a lot of ways you can find that. You can go to other property management companies and see their listings. You can go online to all kinds of, apps and stuff like that to try to find rental properties. You can go to Craigslist, all over the place, just to do some price comparisons to see what other people are charging for a 3-bedroom, 2-bath in this neighborhood, right? And you can kind of price yours where you think. Don't price things too low. I've got the thing that says Goldilocks, not too low, not too high. Don't price it too low. If you're discounting and pricing too low, you're going to get people that are looking for the cheapest thing, and they just trying to get into another property. And you want it to be priced at market or above. You don't want to give any discounts and chase tenants or buy them, basically. You want to get a good tenant in there. So you got to price it. Pricing is critical. First of all, you got to get your money. I mean, you have to get your income, which will be coming off this, to cover your expenses. And you want, to make some profit on this thing. So you got to price it right that way, but you can't outprice the market, or else nobody will come there. Or they might come and then it's just too expensive for them and they'll leave. So location is important to pricing. Obviously, I can't charge rent in Orangeburg like I can charge in Charleston. The features of the property: 3-bedroom, 2-bath. Does it have washer and dryer? Does it come with appliances? How nice are the appliances? Is it across the street from a park? How far is it from the grocery store? I mean, all these different things. What are the features? Is it off-street parking? The more features you have, the more you can charge. Condition of the property, I talked a lot about that. So pricing, very important. There's no magic price. You just have to kind of figure that out. And tenants will try to negotiate with you on price. And I wouldn't necessarily discount, but if you find somebody who's really good and they want to get locked in and they have all cash for a year, or things like that, you might consider some discounts or coming up with a lower price, things like that. A lot of different ways to go with that. Promotion. So how do you find them? You set your price, right? You've bought your real estate, you set your price, you got a decent location, or you have whatever it is that you have. So you can actually hire the property management company just to do tenant placement. So they would probably do it for first month rent. Might be more than that, depends on the market and the company, but I know that I've talked to them, and usually it's like they'll do it for first month's rent. And it's a good service because they'll find you a quality person. They'll do all the background checks. They'll do, the screening, all the figuring out, right? And then person moves in, and then you just start collecting your money. You can always put a sign out in front yard. That actually is it works. You can put it on Craigslist. You can put it on Facebook now. When I post a rental property on Facebook, I will have like 100 people within 24 hours. The problem with that is that's a lot of people you got to sift through. So you need to anytime you create an advertisement, you need to put some qualifiers in there somehow, right? Can't be illegal qualifiers. It all has to be legal, but there's things that you can do, Yes, you have to complete an application. Yes, there's a deposit, there's a pet fee, there's a um, uh, first last month's rent. You put all that stuff up in the up front, right? Then all of a sudden it'll start to screen people. It'll automatically start to screen people out because they'll be like, well, I don't want to pay first month, last month's rent, or I don't, that deposit seems too high for me, or what I'm saying. So you want to get those people out anyway. But then Facebook, there's a lot of different, you'll get a lot of different things, but you can also have a website that you can steer people through where you don't talk to nobody. You say, hey, if you're interested, just go to this website, fill this application out. I don't even have to talk to you. And then, you know what your criteria is. You can set parameters and filters to filter out, or at least move to the top the applications that are best. You can do, so you can it's not very expensive to do a website. And there's probably other ways to do that. And there's apps that you can get, there's property management software that you can buy, which can do these for you, these screenings, and help you with that. But yeah, website is good, not necessary. You can put your stuff on the real estate apps. Your reputation is probably one of your best things. Remember, I've been doing this for over 20 years, so people just call me like once every couple of weeks. Oh, do you have anything available? And I have past tenants that call back and say, hey, I'm moving again. Do you have something available? Because I loved renting from you, right? So your reputation and that, going back to that brand and how you treat your property and your tenants and things like that, and the hospitality, that goes into, working with tenants. That's it. It creates, repeat people, and then they refer you. I mean, all the time I get the calls. Oh, my, sister's moving out. Do you have a place? Because they know that I do that. And most of the time I don't. So they just have to catch me at the right time. But reputation is good. And then also having, friendships. I didn't put this on here, but I guess it's word of mouth as well. Collaborations with other landlords. I have probably 2 or 3 other landlords I know very well in my market. And so when people call me, I'll be like, here, call these people, or I send them to the property management company if they hadn't already gone there. I say, well, try these guys, they might have something available, and vice versa. They'll do the same thing, for me. So it's good to have kind of like an association of landlords. So you can talk about things as well. So a lot of different ways to get a tenant. But like I said, it starts with having the right property in the right condition, the right location, all that good stuff. And then screening is big. Because if you have the right property, it sells itself, But if you don't, you just might have to work a little bit harder to find a tenant. So how about onboarding? So you do some screening. What's part of the onboarding? You can do the screening online, like I mentioned. You can email back and forth. You can instant messenger back and forth. You can do paper applications. I've done a combination of all of these, where you talk to people and then you meet them there, and you give them a paper application, have them fill it out, right? Or lately I just emailed them the application. But the thing about like showing the property too, getting back to screening, I mentioned like I'll put it up there. You get 100 people interested. You want to go show 100 people the property? No, I don't have time for that. I can only show I only want to show like maybe 2 or 3 times. So I really need to pre-screen them before they can even see the property, or I go show it to them. And that's another benefit of having property manager. The property manager can, show it. You don't have to show it. So you got to screen before you even show, because you'll waste a lot of times if somebody just calls you and say, oh, you're interested? Okay, I'll meet you over there. Unless you're retired and you just want to do that. that's fine. I mean, that's your prerogative. But if you want to be efficient, then you screen them. If they're interested, you'd be like, fill this application out. Don't want to waste your time, right? With somebody who doesn't have a job, doesn't have income. When you're looking at income, you want to verify, and this is getting the background check, reference, and credit report reference. You want to verify their income. And let's just say they have a job, they make $2,000 a month, and the rent is $500 a month. Take home is $2,000. Well, that means that the rent is going to be 25% of their take home pay if they're living by themselves and they don't have multiple income. There is a threshold there. There's a cutoff you want. Everybody's different. 30%, 35%. You can get more liberal and say 20, 25%. So you really need to figure out, that they can afford to be there. I don't know how many applications I'm just like, you can't afford this place. You can't afford it. Oh, I want it. I want it. You can't afford it. Unless you have a roommate that has income that can make it worthwhile. Because I was like, how are you going to pay utilities, groceries, all this other stuff? It doesn't make sense with your income. So you really need to understand income, and you need to verify income. People write down anything. Background checks, you don't want, that's up to everybody. You can let anybody in your property you want to. But just understand that, they could be a registered sex offender, which would, that has implications. If they, have a felony conviction, things like that. If they can be the nicest looking people, but I can tell you it's happened to me many times over 20 years where it turns out somebody would get into the property and they bring their cousin or their brother or their, spouse or friend. They get them in, right? Because they had a conviction. And then it always ends up not good. I've had cops, every agency you could imagine at my properties with some people. So, but that's why you got to do the background check. You got to try to be real strict about, who's in the property and stuff like that. References, you need to check your reference, check the last landlord. People will lie on that. And maybe even be their friend that you're calling or their aunt. I live with my aunt. But you need to check references because people bounce from place to place and they work the system. And they just got evicted from the last place and they saved up two months of rent to put down on the next place. And they didn't pay the last landlord, right? Because they were saving. They weren't paying him. They were saving for the next place they were going to get out. There's a lot. So if they give you the name of the last landlord, and some people will do that, and you call them and they're like, oh, this person owes me X amount of money. That's probably not a good, tenant. Credit reports are good too. Not the be all end all though. Anyway, all a part of the screening. I put last thing, patience. You got to have patience to find the right person. It's critical not to put the wrong person in there. You will pay dearly in the long run if you put the wrong person in there in many more ways than you can imagine. That's why it just pays to just, you might not be making money for a month or, just waiting on that right person. And people do get anxious about not getting rent when they've got mortgages and expenses, especially if you did this you really didn't have the capital behind you to do it. And you kind of did it to get into it and make money somehow, but you didn't have a whole lot of money. Not necessarily the right thing to do. But anyway, takes patience. Let's see. I had a question here. Where do you get background checks and credit reports for possible tenants? Yeah. So one thing is, yeah, if you go through property manager, they have all that in place. If you're doing it yourself, there's a ton of services out there. Honestly, you can Google it. You can get SLED. SLED will do a criminal background check, $25. But then there's other services that'll do it for you, around 25-ish or so or more. Credit reports you can get out there as well. As there's different services that you can use. Yeah, it's just a matter of going in Google. I won't recommend one in particular because there's a lot of them. There's a lot of stuff around this industry. So record keeping. So I mean, you got the right property, you got a tenant in, you're operating a business, and you are operating a business. If you're renting out a property, whether you came across it through inheritance or whatever, family member gave it to you, or friend, it's a business. And record keeping is of utmost importance. And if you're ever going to do this for a living, where you do property management, you rent other people's property for money, it is like record keeping is mandatory unless you want to go to jail. But for the purpose of getting into property investment, you need good record keeping if you're ever going to expand this business and buy more properties and those type things, because the bank needs to see the story on paper, on numbers. And they need to see that you made net income or profit. They need to see that there's equity in these properties and you know how to manage them and stuff like that. Mainly, they need to see that you made money. Because honestly, if you went to buy more property, and you were going back to the bank, and the bank is going to do they're going to do underwriting with your income. And so if you have another job and your spouse has a job, you'll have those two sources of income. And then you have your rental property, that's a third source of income, right? And so now they're looking at your total income, and then they're looking at all your expenses. Collateral is really not an issue because whatever you're buying is going to be the collateral. But so they're looking at your expenses, and then they're saying, okay, they've got additional capital, to be able to support this, right? But what they do is on that new property that you're planning on buying, let's say rent is $1,000 a month. When they're doing those calculations on your income, you would say, okay, well, they're going to calculate $1,000 a month of additional income from this new property that I'll be getting. Nope. They will discount it to $700 a month. Generally 70%, maybe lower. Maybe different. All banks are different, by the way. But there are kind of industry standards, and a lot of them hover around the same thing. But they're going to discount that because they're going to say, oh, there's a vacancy rate. And there's other issues that come up, right? So we're only going to give you 70% of that income. So then that kind of crunched down your debt to ratio income, or your debt to income ratio, whatever, so that it might not make the property work. So anyway, that is part of the importance of record keeping and financial record keeping. Anyway, so let's start with the lease. Why do you need a written lease? You don't have to have a written lease. It could be a handshake between me and you. You pay me $400 a month, I accept it. Great. We've got an agreement, and that's perfectly fine. But you leave yourself open to all kinds of issues. Like if you ever want to get them out, that would be the first reason you need an agreement, a written agreement, because you have this written agreement for the worst case scenarios, and also it spells everything out, all the rules, the terms, everything. If you don't have a written agreement, you can always refer back to the Landlord and Tenant Act, to try to figure out, how the laws apply, the statutes apply to you. You need a written agreement, though. I mean, it's like, if you're going to do this as a business, do it. Get the written agreement. You protect yourself. It can be a lease, a long-term lease, or it could be a month-to-month agreement. Depends on what's right for both of you, right? It could be a short-term lease, like maybe you rent to students, they only need it for 9 months. Maybe it's a summer rental and you want to lease it long-term, but you only want a month-to-month on it, or even a weekly. So there's a lot of different reasons why you would use month-to-month versus lease. Some people want to be more mobile and be able to get out of the lease. So usually if you have a month-to-month, you want to charge more. Because you would charge a premium on a month-to-month because they can up and leave on you. And then you got to find someone else, and it costs money to turn the property over. But if you have a lease and they're locked in for a year, that's much better. It gives you more peace of mind. You can get them, their standard rate. And you can give them options to extend that lease. And things like that as well. A lot of my leases, actually, there'll be a 1-year lease and they'll just roll over to a month-to-month after that. That's just how I do mine. You can redo the lease every year for another year, however you want to do it. Some people ask for another year because you can evict them. If they're on a month-to-month, you give them a 30 days notice, you can get them out of there for whatever reason you want. And so they might want the comfort of having a long-term lease, and knowing that you're not just going to get them out there because maybe market is going up and you can, maybe find somebody that you could charge more. Not that you couldn't raise the rent on them, but anyway. And then, so there's terms to consider in the lease. So how long are they going to be there? Don't want to make it too long. Usually 1 year is kind of standard or less. Deposit, first, last month rent. I usually do deposit, and I hadn't really done a lot of first and last month rent in my market, but I mean, I could recommend it, and I only recommend it. I would recommend it because, well, first month's rent is fine because they'll go ahead and that'll be paid for, but last month's rent, what a lot of tenants do is they paid the deposit. And a lot of times landlords make the deposit the same as the first month's rent, which I wouldn't necessarily recommend because it makes it seem like, oh, that's the rent. So the deposit's there to cover the last month's rent. No, it's not. It's not there to cover the last month's rent. It's there to cover damages and, other things like that. If you break the lease, it's there to cover that, the breaking of the contract. But what the last month rent would do is what happens. A lot of people will, they'll leave you, and that last month they won't pay you, and they'll just be like, oh, my deposits can cover that. So if you have the last month's rent, then the last month's rent would cover that, and then you would have the deposit. That if there's any damages or if they broke the lease, you could keep the deposit and things like that. But you need your written agreement to spell all that stuff out too. How deposits work, how they're refunded, what happens if you don't return keys, what happens if it's damaged. All that is in the written lease agreement. If it's not, you might have issues with getting your money back or damages and things like that. One of the critical things that's in the lease is the final notice. So there is a clause on the first page of every residential lease, written in bold and conspicuous language, that says, "This is your final notice if you didn't pay." This is your final eviction notice, basically. So if you didn't pay rent. So what that does in the state of South Carolina, by the way, laws are different in every state. So if you're not from South Carolina, it's going to be different. But in South Carolina, if I need to evict somebody and I go to the magistrate, I hand them the lease and it's got that final notice clause on there. They look at it, they make a copy of it or whatever they do with it. And they're like, okay. And they start the eviction process. If you didn't have that, there's a whole process you're going to have to go through to give them notice that they're getting evicted. And I'll go a little bit more into that when we talk about separation. I won't go too far. I'm just saying, as a part of this written agreement, you want that final notice. And if you go to Google South Carolina Real Estate Commission lease, I think that might be it. There's like a standard South Carolina lease out there that you can find. It's got that clause written in it. And you can use that to design your lease. You can get a lawyer to, create your lease. A lot of different ways you can get leases. And if you're doing a month to month, even if you're doing a month to month, I always start them out on that normal lease agreement. And then it just, after the first month, it'll just roll over to month after that. You can have like a 1-page month to month agreement that's kind of simple, but more protections in the longer lease. So what are some other documents that you need? Rules. You need to give them rules. Disclosures. There's lead-based paint disclosures if the property was built before 1976. Maybe there's other disclosures. Condition checklist. This is important. When you're checking somebody into a property, you need to give them a checklist of all the issues that they find. That's because when they leave the property and you're looking at the deposit, you go back in to inspect the property, and they gave you the checklist, right? And it said that there's no damage in the master bedroom, but now you go in there and there's a hole in the wall behind the door, or the carpet is ripped up in the corner, or whatever the damage is, right? So now you have proof. When you say, well, we got to repair this, then when you take it out of the deposit and they're like, wait, what did you take that out of my deposit for? Well, this is what we took it for. By the way, you have to disclose within 30 days, I think it is, the reason why you're taking out the money from the deposit. So they need to give you a forwarding address, right? But anyway, then you would use that condition check. You're just like, well, you didn't check that there was anything wrong there upon initial inspection. And you should inspect, and they can inspect too. So you both have your checklists. There's a rental insurance brochure you can give them, smoke alarm policy, and of course the application. So I mentioned accounting right off. You need some form of accounting. QuickBooks is great for it. There's a free accounting software called Wave Apps. You can do it in spreadsheets. There's other apps out there. There is specific property management software, which is really good. It's just you need to be doing a lot of management to probably, to pay the prices that they ask for those pieces of software. But it's worth looking into them. You get trials and stuff like that. You'll need to track rents, other income expenses. You need to maintain your balance sheet, which is important if you're going to go buy more real estate. You need to track depreciation, and your tax returns are on Schedule E if you're not a partnership or a corporation. So anyway, those are some other accounting things to consider. Counting is important. Goes back to what I said the first of this part, is that if you're going to get more properties, you got to do accounting, because the bank speaks in financial language. And that's how they understand what you're doing in your business. And just for your own, just to keep up what's going on, so you don't want to lose track, of what's happening with your property. And I actually use an app. I put apps there. I use an app. And the app is called, and there's different apps out there for iOS or Droid or whatever. The one I use is called Landlordy. So I have all my tenants in that app. And when I go collect rent, or at the beginning of the month, it loads their rents that are owed. And when I collect rent, I go open the app up, and I just said I collected it. And I told them how they paid, and boom, it helps me keep track. And it's on the phone. I do it right there when I receive the money. And then later, I can go to my other softwares like QuickBooks and, Reconcile and things like that. But you do need something, honestly, you need an app on your phone to keep track of it. Even if you have one property, you should do it. It just helps you keep track of the day that it was taken, all those other things. And I always give tenants a receipt, especially if they pay cash. But I'll say something about that real quick too. Don't accept cash, first of all. I only accept cash in like weird situations. They need to pay by money order, check, or credit card or cash app. But I'll tell you something about cash app too. But don't accept cash, especially when you go to the property to collect rent. That's just asking for you to get mugged by somebody. You walk out, people know, they probably recognize you as a landlord. If it's a neighborhood where people know people that come and go and they look and they're aware and they've seen you working in the yard or working on the property, they know you're the landlord. You go knocking on the door, you're talking to him, you're walking away, they're like, I bet he's got, rent, especially if you're holding in your hand a big wad of cash. You just got to watch out for that, and that's why I don't accept cash. And cash there's no tracing on cash, and there's a lot, I wouldn't recommend it. Money order, check. If they bounce a check, only money order after that. And of course, now you can pay online. Just if they pay online with debit, if you set up a software system or a method for them to do, you got to charge them extra, because there's like probably a 3.5% fee. So if they're paying $500 in rent times point, let's see, 0.35, that's $1,750 in merchant fees. That just came out of your $500. And if you're paying $1,000, that's $33. So you got to pass that along to them. So if they want to use, the credit card, you got to have some type of fee to account for that. Cash app, you can take cash app and there are no fees, right? And you can do PayPal, friends and family, and there's no transaction fees. The problem with both of those, PayPal, friends and family, and cash app, is they can contest that and actually get their money back with some of that stuff. So you got to watch out and just be careful, because if they're paying by cash app, if they dispute it, they would end up debiting your account and credited them back the $500, and then they might just leave. Anyway, it's something to consider and look into more. I'll take cash up every now and then if I trust the person. If they've been there for years, which I have tenants have been there for decades. Obviously I trust them. But maybe newer people, definitely not. So anyway, that's my advice on that. Maintenance. All right. If you're getting into rental properties, your number one thing is maintenance. Other than collecting rent, chasing down rent in some cases, which if you have a good tenant, you have to do less of that. And if you make it easy for them, right? Like they can log online, pay through a portal, multiple ways they can pay, stuff like that. Make it easy and convenient for them to get your money without you having to go collect. Otherwise you end up making collection rounds and you're spending a lot of times doing that. But outside of, just collecting and getting people in the property and managing that part of it, maintenance is your biggest thing. So if you're thinking about all the glory and riches in owning real estate, always consider the other side of it, which is the time and money that you're going to put in things that break. These properties have to be maintained, or else they just decline and the value declines and you have to maintain them. It's wear and tear. Can't get around it. So you need to account for maintenance and repairs, and vacancy. Like I mentioned, the bank does. You need to have some kind of budget for it, because something's going to break. Guaranteed. You cannot create a budget with no repair expense or maintenance expense. And when it turns over, when properties turn over, got to go in and paint, maybe change the carpet, maybe fix this or that, spruce it up for the next person. it's going to be a cost to a turnover. So what are some common repairs? HVAC is everybody's. HVAC and plumbing are the two worst because those take specialty contractors, which costs a lot of money. Light bulbs, people can change light bulbs themselves, but trust me, people call about light bulbs, but you got to tell them they can't do that. Appliances break. Refrigerator, stoves are the two the worst. Washing machines, dishwashers. I don't have, if I don't have to have a dishwasher, I won't. But if it depends on if it's a high end, you got to have all these things. But anyway, HVAC, plumbing, then you got common maintenance like extermination, HVAC filters, landscaping, things like that. You can do this stuff yourself. Depends on how you value your time, right? If you're retired, you know how to fix these things, you're handy, which I do a lot of it myself because I'm handy and I just don't want to pay somebody hundreds of dollars to do something I can do, I can fix most plumbing issues, and HVAC I can, do a little bit. And when I get stumped, then I just call the HVAC guy. And even appliances I can fix. But not everybody has that skill set or even wants it, because you got to value your time, right? If my time's worth, $10 an hour, then, do it by all means. If your time's worth $50 an hour, then maybe you want to call somebody in to do it, or if you just value your time with your family and you don't want to be dealing with that. Anyway, get you a good handyman, somebody who you can trust, who'll come with you if you have a lot of properties. They'll cut you deals. They'll come when you call them because they know that you probably got regular work for them. Treat them like gold. Especially if they're giving you good deals and stuff like that. Every now and then give them a gift certificate for a steak dinner or something like that, just to do it. Because when they call, you're like, oh yeah, this dude's great, man. He bought me a steak dinner last year. Anyway, big part of it, maintenance, turnover. Like I mentioned, you got to paint, got to change the locks possibly. They got the locks now, you can put the codes in. So you just change the code. General cleaning, somebody's going to have to come and do that. Flooring might have to be changed out. There's unapproved repairs and improvements when the tenant wants to paint. Just be cautious of that, because everybody is an expert all of a sudden in painting. Hey, can I paint? If you buy the paint, or some of them will buy the paint themselves. Everybody's not a painter. Painter is it's not totally low skill. Like once you learn it, you understand how to paint, but a lot of people just don't understand how to paint. Like you need to cover things up, tape things, use the right type of paint, flat, semi-gloss, you need to understand all of it. What do you paint first? The trim? Trims and, semi-gloss, flat on the wall, or satin on the wall. So they might not know all these things, and they might paint it some god awful color. It's just know your tenant. Like it goes back again to trust. Like somebody's new and they move in, they want to paint. Well, hopefully you probably already painted it, but you probably painted a neutral color. But just be cautious about that. If they've been a long time tenant and you trust them and you kind of know them and you feel like they're capable of it, sure. You just take a risk of them, messing your house up. You just might have to come along and fix it again. So other things to consider in property management is the last section. And I have covered some of this stuff, so this might be a little redundant, but I know in education redundancy is good, because we only hear about 30% of what people say, 70% if you're really good, because we're distracted. We're just human. So by the way, this is being recorded. You can go back and watch it again. We'll send out the recording if you miss something. And of course, you can always call me or any consultant Love to give you advice, hook you up with somebody, from bankers to, whoever, and just kind of look over your deals or look over how the property's being managed and make some recommendations. Would like to do that. So anyway, moving tenants in. We talked about that a little bit. This is a part of a day-to-day thing. Collecting rent. I mentioned this already. Cash checks, cash apps, online portals, trade. I didn't mention that. You're going to have a lot of tenants that are going to want to trade. Depends on how valuable the trade is to you. The IRS doesn't necessarily like trade. They do ask you on your tax return if you made any trades. But like if the tenant wants to paint, the tenant will be like, hey, I'll paint. Can I paint? And you give me a month rent. No. Number one, you're going to hire low skilled labor when you can just hire a painter for that same amount. You know what I'm saying? That's skilled. And then, we'll do a good job. No. And trades are just, trades can go awry a lot of times too. So just really be cautious of a trade. And honestly, you need to account for that money, with the IRS as cash, especially if you want to grow the business. Because if you're not showing cash, you're not showing net profit. The bank goes to give you a loan. They're like, well, you don't make very much on these properties. Well, that's because I traded with everybody. Okay, that's good for you. Well, that didn't help you get a loan. So just consider that too. But some trades can be really good. You can get the real good side of a trade, and just have to take all the considerations. Communicating with the tenant, I basically underlined that because that is probably one of the key things that you need to do as a landlord is keep communication open. If you got a property manager, they're doing all the communicating. If you're a manager, you need to communicate with this person. And if there's a lack of communication and there's long periods of silence, be worried in some cases. But especially if they didn't pay rent, right? Sometimes if they don't talk to you all month and they pay rent on time every month, and great. You still need to check on them from time to time to make sure everything's okay. With the house, any maintenance that needs to be done, preventative maintenance, whatever. Are they still alive? But if people aren't paying rent, and all of a sudden you're going, wow, that's where you start the progression. And I didn't get a whole lot of that with tenants, and I think it's going to come into this separation. So anyway, you'd have to start a progression and get going on making them pay. But anyway, communication is key. There's a lot of different ways to communicate these days: email, text. People love to text. So doing property checks, ride by your property often, at least once a month, if you can. Go into the property if you collect rent, in person, go into the property, or you can look in. You can do inspections. You have to give them a certain amount of notice before you go in there. And that it depends on the relationship you have with them, whether they like you doing that or not. But it is your property. And you can go and change the filter, right? The air conditioner filter. And when you're walking through there, you can kind of see what the condition's like. So that can be done once a quarter, change of seasons. But check on them and automate, make it as automated and easy on yourself as you can. Separation. What do you do when rent is late? It goes back to communication, right? Rent's late. You're like, where's rent? It's the 5th, right? Usually you pay on the 1st, late after the 5th. But you can pay on the 15th, late after 20th. But it's a 5-day grace period. So when that 5-day grace period is up, generally speaking, there's a late fee. And then a process would start, or a progression. to where you need, if they're 5 days late, you need to be in touch with them and be like, what's going on? You can text them, you can send an automated email, you can do it however you want, you can call them, which nobody probably answers. Or you can go by, but I wouldn't go by at that point yet. So 5 days comes, you're like, oh, that paid rent still. What's going on? And a lot of times, if they're a good tenant, something happened, they'll let you know. Most times, they'll tell you in advance that it's going to be late. But then they'll be like, oh, this happened, that happened. Okay, cool, great. We talked. I understand. You're going to pay it on this date, right? Communicate. You got it clear. They don't respond, and now you're getting 10 days. Then, some people, like companies, they send letters at 10 days. They may send it at 5, or emails. 10 days, you're sending something. 15 days, you going over there. Probably. You can send another letter, certified letter or whatever. But I mean, if they're not talking to you anything, you go and do a property check at least and be like, what's going on? And first thing I do is 15 days, hadn't seen them. If it looks kind of weird, I go check the meter, the electric meter. Okay, power's still on. Looks like somebody's still here. They didn't just, abandon us. But 15 days, you're probably, if you hadn't talked to them, then you're going to start on some eviction processes here. The thing is, as new landlords, you try to give people the benefit of the doubt. And some people that have been there a long time, you might can work something out with them. Like they might be paid at the end of the month, because it depends on how their paycheck comes, right? Maybe something happened. Maybe they had to go to the doctor. So, hey, you got to wait for this next paycheck. It's going to be the end of the month instead of beginning. That's great. Okay, great. We communicated. We'll work that out. If it gets to be too often, then it gets to be a problem at the end of the month, because what happens is that rent point of collection keeps moving back. And so you move it to the 1st to the 15th, and they move to the 15th to the end of the month. And then all of a sudden they're at the beginning of the next month. And so now they owe 2 months rent. And then all of a sudden you've got them owing 2 months rent, because you're 30 days, you still hadn't gotten them out, and you're not really escalating things. And then you're starting the process, and then you're probably going to end up 3 months out of rent by the time the whole eviction process is over. So at day 15, you got to figure out if you're going to go or not, or if you're going to go into the second month. But anyway, you've got to think about starting eviction. That goes back to your lease. You have the little emboldened conspicuous language. You've got the writing that says, hey, this is your last notice. You take that down to the magistrate. Normally, if you didn't have that, you've got to send them a certified letter, and you got to go through all this rigmarole about giving them notice, right? You don't want to do that. And I don't think the deputy doesn't have to serve them that initial notice. If that happened, then sheesh, you definitely don't want the deputy doing it. But if you have that clause, you don't have to worry about that part at all. They'll go ahead and start the process. And what that process does is the tenant will get sent a letter about how much they owe, and that they need to call the magistrate to set up a court date. And so the tenant's got 2 options. They got 10 days, I think, 10 days to respond to the magistrate. And if most of them, 9 out of 10 will ask for a court date. If they don't, then after that 10 days, I call the magistrate. I say, hey, did they set a date? And the magistrate will say, nope, they didn't set a date. You come down here and get an ejectment. If they said, yep, they set a date, then I was like, okay, well, they'll send me something in the mail, tells me when my court date is. And that can be another 5 or 10 days. Get your court date. A magistrate, if that person owes you money, there ain't no magistrate out there that I know of, have ever come across, that won't side on the part of the landlord. The first questions from the magistrate should be, do you owe the landlord money? And if the tenant says, yes, sir, but don't matter, everything after the but don't count. he owes that landlord, that he's breached the lease. He owes that landlord can get an ejectment that minute. It doesn't always go that way. Some judges are, I don't know, they just got to put on a show or something. But never lost a case in my life. And most judges will say, they'll stop it right there and be like, landlord, what do you want to do? And I'll say, I want them out. I want somebody who's going to pay rent. And they'll be like, okay, we're going to do a writ of ejectment. You have 5 days to get out or whatever it is. And so they're given notice right there. And then they got to go get ready to get out. And then I've got to go back and get with the deputy. You know what? I take that back. In the beginning of the process, you are going to have to serve notice. So you had the first thing, you didn't have to get the certified letter because you had it in your lease. So, but whenever you go to serve the actual eviction notice, it's got to be served. And you can get the deputy to serve that, which you do not want to do. I stress. You want to hire a private server. A private server is going to cost you $25 to $35 probably. And they will go hunt that person down and serve it. And they've got ways they can do it that a deputy ain't going to do it. The deputy will walk by there, knock on the door, nobody's there, I'm gone. On to the next thing. A private server, well, they'll figure out what's going on here. They'll talk to me. They'll be like, what's going on with this person? I'll find them. I'll get it done next day. The deputy will be like, I'll get you on about 3 days. 5 days goes, oh yeah, I finally got it. So you do need that served. I forgot, you do need that served in the beginning. But you're going to have to, if you go to eviction, you're going to have to meet the deputy. And then, there's a deputy that usually does it, one or two. So you get their numbers, you call them, because if you wait on them to call you, they're going to take their time. So you call them, you say, hey, I know them, I say their names, I got this eviction. And she goes, yeah, I saw it. When you want to meet, so forth and so on. But anyway, a lot of good war stories with evictions. And if you're in it long enough, you'll have probably plenty of yourself. So I did talk about deposit a little bit, and tenants moving out, went back to the checklist, just consider all that. You can keep deposits if they breach lease. You can keep the deposits if they breach, if there's damage and there's things in the lease that, spell out, what gets taken away with a deposit. So that's why you need a lease, and starts with finding a good tenant, just like I've been saying. So some other resources just to pass on to y'all. This top one is a landlord, real estate investors, and property manager hub. It's a Facebook group. Join a Facebook group. You could actually ask questions to these people. They're all around the country, so laws differ, but they know real estate and they know managing, right? So it's a perfect group to get involved with and to understand and share your experience with other people. That's what it's all about, is the sharing. There's also a podcast. If you listen to podcasts and you're getting into investment property and property management, subscribe to the Rental Rookie podcast. Awesome podcasts. And you can go back and listen to their history. They've been doing it for years, and they have the best episodes, and they just talk about any kind of, issue in regards to investing, managing any of these properties. Really good podcast. Educate yourself on your industry that you're in, your business. You're taking a class today. Obviously, you're proactive about that, and you're concerned about education and knowing, what you need to do. Listen to podcasts, get involved in groups, get involved with, people in your community that are in landlording, like I said earlier, and, it will help you along for sure. So I'd like to thank everybody for joining today and getting this overview in property management. I did talk for longer than I thought I would, going on 2 hours here. It's kind of a lengthy. But I probably got into some things a little bit deeper than I needed to. But definitely like to thank y'all. If you got any questions, I'd be glad to answer them now. Also, find us on SBDC, and hope you have a great rest of the week and good luck in your real estate efforts and future. Don't see any questions here. So with that, take care.